Recently, Bob started BKREA, an investment sales and capital markets brokerage firm in New York City, which will blend best-in-class analog data sets with artificial intelligence technologies to create a new brokerage firm for a new era. Bob, welcome.
Timmy, thanks so much for having me on. Bo, so great to see you, my friend. And I must say, I've never felt more like Austin Powers than I do right now.
Yeah, baby, yeah. I got to say, Bob, we did a episode about 10 episodes ago where Bo was teaching me how to answer the question, how is the market? And we used you as an example, a little clip from Tripwire.
Yeah, we got Tripwire's permission to pull the little clip where you were describing the market. And in fact, you know, for all those listening in live right now, like, let me just start off real quick. Bob, how's the market in New York City?
How's the market in New York City? Well, Bo, I'll tell you, I think the New York City market is headed for the largest sell-off in history.
Wow.
In using Manhattan as a microcosm of the market, south of 96th Street, there's 27,649 buildings. The average turnover rate of that stock of buildings has been 2.6% over the last 40 years. The lowest it ever was before the all-time low at the bottom of each of the corrections the market has had. So we'll go back to the early 90s during the S&L crisis, go back to the recession in the early 2000s. It had gotten down as low as 1.6%. Well, in 2009, during the GFC, it went to 1.2%. The highest the turnover ever has been was 4.3% in 2012, as investors were rushing to beat the 3.8% capital gains tax that was embedded in the healthcare law. And we believe that with what's going on now in the market, that turnover in 2025 and 2026 will be over 5% in each of those years, setting a new mark for transactional volume in New York City.
Over 5%.
Yeah, absolutely. There are a lot of folks who, you know, the interesting thing, we could talk for a long time about the market, but basically there are several things that are differentiating this correction from past corrections. During the savings and loan crisis, early 90s, recession, early 2000s, GFC, you know, all property types were losing value. It was just at differing degrees. Today, the thing that describes the market is that different property types are performing differently. I would argue today that the industrial market in New York, although it's only a very, very thin slice of the market, is doing very well. The retail market is on the upswing. It started to get negatively impacted 3 or 4 years before the rest of the market was, but retail rents have stopped going down, leasing activities picking up, investor demand is back. So that's been a good sector of the market. Our hotel market is doing really well. We have 120,000 hotel rooms in New York, or I should say had. 30,000 of them are no longer hotel rooms. 14,000 were converted to student housing and other uses. 16,000 are occupied by migrants. And so the dynamics in the hotel market are great. ADRs are way up, occupancies are way up. So that market is doing well. And the two biggest sectors we have in New York, which are the multifamily market and the B and C office market, are both taking their lumps. You know, the multifamily market was negatively impacted by policy changes to our rent regulation system in June of 2019. That was the first body blow. COVID was the next body blow. Now we have more legislation that's going against the industry. And with the interest rate policy the way it is, almost every refinance today in the multifamily sector is a cash-in refi. Most folks don't have that capital, so it's forcing some sales. And then in the B and C office market, we have buildings that we're selling for $750, $800 a square foot that are now selling for $300 a foot and even $200 a foot. So price per foot has gotten back to the point where it was 20, 25 years ago. But just by nature of the fact that a lot of those buildings have $400 and $500 a foot in debt on them, those properties are being sold through cooperation with the lender and a variety of other ways. But there's a lot of folks who, for the properties that are doing well, there's pent-up demand to sell at these slightly increasing prices. And for the sectors that are doing poorly, there's a lot of sale because of necessity more than anything, and needing to raise capital to refinance and hold on to the properties that you want to hold on to.
Now, see, is that not much better than answering that question with an adjective?
They're so much better. Yeah.